everybody. Welcome to Friday, another Talk Money with Tom show today. Really happy everybody could come and join us. We try to help you with your retirement, and we do that by answering your questions. So you can send in the questions now. Ask Tom at talkmoneywithtom.com. We'll try to answer them live. You can put them in on the chat. You can send them in during the week, and we'll try to answer them next week, whatever works for you. Obviously, we've created this channel. I feel like there's some benefit to being more educated about the financial aspects of retirement. And so we focus on, how to manage the money, how to, lower the taxes, and how to plan for retirement as far as that goes. So lots of content on our channel. You can go check that out. You can subscribe to it. You can hit the little bell to get notified when something new comes out. And then obviously, if you just want to meet with us, you can do that also. There's a link to our website on this channel. Up in the corner of our website is a book appointment button. Looks just like that. I can set up a 30-minute time to meet with Ethan and I, and we'll be happy to answer some of your questions on a personal basis. So that's our show. I hope everybody gets something out of this. We try really hard to make sure that there's some content that covers a wide variety of things. However, whether you're 20-something, 30-something, 40-something, getting ready for retirement, thinking about it, getting starting to save for it, or you're already in retirement, a lot of the same things apply, at least in my opinion. So hopefully everybody gets something out of that. All right. I do like to start off the show each week with kind of a summary of what's happening in the stock market. And so I'll share a screen here. This has been a really fun market, actually. It's really kind of amazing altogether. You can see here, this is a pretty long chart going back to 2019. This is weekly data, but I think it's kind of incredible to see what we've been through with the pandemic, the big run up after that, the inflation that happened in 2022, and we've been climbing since October 13th, 2022. That's when we hit that low on that particular downturn, and finally broke into a new all-time high this year. So April was kind of a poor month, right?
Yeah.
But May is kind of making up for it, and we're getting what I call a V recovery, right? Where you come down and comes kind of straight back up. There's a U recovery where it kind of sits around for a while before it finally comes back around. Had basically a V recovery there also last year, starting at that low point in October 27th, and so. It's kind of interesting because as the market falls, you hear about all these reasons why the market's falling and how much more it might fall. I did feel like in April that things should come down a little bit further just because we'd run so much.
Yeah.
And there's no real support to stop it, right? However, we ended up with a 5% downturn instead of probably a 7 to 10% downturn, which is kind of what we needed to get back down to support. To me, that shows the strength of the market. And the last time this happened, you can kind of see it if you look closely, but in 2021, the market was really strong, and it had a few little dips, and every time it dipped, it came right back. It's just a lot of interest to buying stocks and coming into the market. We're starting to see that again. And so, why is this happening? Well, there's this constant inflow from 401ks, right? And you got matches on the 401ks. There is a tremendous amount of money in 401ks, and every paycheck, is adding to the stock market. And a lot of times, even when the market's bad, people just keep putting money in. They don't really manipulate the 401ks like they might some of their other accounts, at least in our experience and in our opinion. And so there's this constant cash flow, and there's a bigger ownership nationwide of stock than there used to be, right? Partly because of the 401k. It used to be you had a pension and no 401k, and so now there's no pensions for the most part, except for public sector, and really it's made up for theoretically with this 401k and maybe a match. However, there are periods of time where things are kind of exciting. In other words, in this period, inflation is, it's in that 2.85% range on the core PCE year over year for the last report. Not at 2% where the Fed wants, but I've been saying for a little bit here that I think that really, the 2% number, I've been reading up on this, was really kind of just picked out of the thin air. There's no real economic situation. As a matter of fact, they had trouble when they were hitting like 1.75. They were kind of, worried about deflation. So I think it's a little bit low. And I read a great article talking about how it should probably be in a range, 2 to 3%, right? And so we're already there. I read another article this week talking about how when the Fed stops raising rates and doesn't lower rates, what they call the pause, which is where we're at now. That last rate increase was what, July of last year, right? So we've been in this pause. The average rate of return during a pause, if you look at the last 80 years, is 14%. And so that's, basically a pause has some positive to me because if they're lowering rates because the economy is falling apart, the stock market's going to come down with it. If they're not lowering rates and the economy is doing well, that's kind of where we're at right now. The economy is doing quite nicely. Inflation, I think, is still a concern, even though it's in the right range on a year-over-year basis. This first quarter reports that we've got on inflation have been, a little bit high.
Yeah, and consumers are, from the sentiment, we're quite worried about it.
Yeah, exactly. So that came out today. The market was up more today, dropped a little bit today. The consumer sentiment survey was quite low. People are worried about the economy, obviously, mostly, I think, because of inflation, just seeing costs go up.
Yeah, we'll find out next week when CPI comes out on Wednesday. Otherwise, this week was relatively, I don't think there's any major macro news from the economy.
Yeah, we even had a 0 day on Wednesday. Basically, we've gone up every day. If we end up today, we'll see. But this week, and we had a 0 day, which I haven't had, and I've done over 1,000 daily videos, and haven't had a 0 day. We had, basically no change on one day. There's not a lot going on. No, the market can do quite well though when there's not a lot of reports. Yeah. It kind of shows you. I guess the saying would be that whatever the primary trend is, it's just going to float in that direction without without interruption from all the different data points that might come in. So it has been a slow week, but it's a good week. We're almost at a new all-time high again, and I'm gonna share again. Oops, got the iPad went out. 60264. This thing's still up. Connection lost. Find out. Yep. All right. So this is the hourly data. I presented this last week. I just think this is kind of fascinating. If you follow the primary trend concepts, one of the pieces of that is, the higher lows if it's an upward market, or lower highs if it's a downward market. Okay, so if you followed that, you would have made some really good entry and exit points looking at the hourly data. So I just keep this going. Let's just see how it goes. And so we can see on this last upturn here, we now have 4 low points, all of which are higher than each other. So we're still in a 1-hour primary trend. Not that important, other than the fact that we're just trying to see, what type of power do we have to kind of get back to a new all-time high. And so we're close. We got within less than 1% yesterday, kind of getting to that high. However, there is a little bit of a consolidation zone that we're in here. And so you can kind of see it's waffling a little bit as we've gotten in there, kind of ripped right into it. And then we had that little low point. I suspect that we'll get to a new all-time high, maybe even as early as next week. Maybe depends on the CPI.
The CPI could change.
It could change things. We'll see how that goes. But the momentum is definitely to the upside. One of the things that does happen, and we've seen this over and over again, when you get to a new all-time high and you're just about to break through, there's some selling pressure right there. People have sell orders in at that price point. That's what they call resistance. So it might take a little while to get there, but things are doing quite well, actually. I'm really pleased with how the market has gone here altogether. It's been really showing its strength. And the momentum is definitely to the upside, no doubt. And because it came down, it's had a period of time now. And if you look back, we're at where we were, 6 weeks ago. So we've basically gone sideways for 6 weeks. That's not a bad thing after that huge 5-month run that we had.
Yeah, you need to take a break every now and then.
Yeah, I think, and I've talked about this all the time, but I think it's really healthy. You get a market that just overruns itself. It can sell off in a really big way, and then it kind of catches a momentum. We saw that in 2000, where it starts to really come down. Those make me more nervous than this scenario where it runs up and then takes 6 weeks and kind of goes sideways, because I'd rather have a more sustainable advance. There's nothing we can do about it. We don't control these advances, It's just, what we vote for, what we cheer for, and, what we look for. And so I also think that it's a good way of looking at some of these downturns because sometimes, people, oh my gosh, the market's down 5% or whatever, well, that's not a bad thing, right? In this particular case, it's a good thing. So anyway, that's what we saw happening this week. Again, I think that it's a good week altogether. Great time to be in the market as a whole. We'll have to see how things play out next week when we get the CPI report, but pretty good week this week. Very, very pleased. All right. So what do we have for our first question?
What are your thoughts on AI trading programs? As AI becomes more prevalent, they're starting to get integrated more into trading and kind of the financial systems.
Yeah, this is a question that came in during the week. We've been talking about it some. It's kind of interesting. So there's a lot of different pieces to AI, one of which is the possibility of being incorporated into a trading system. The thing that strikes me, just for starters, there are already algorithmic trading programs out there.
Yeah,
Not quite this.
as long as there have been computers, people have been using them to trade.
Yeah,
Systems.
Renaissance Technologies, which is a really famous firm run by Jim Simons, who just passed away yesterday, actually. There's a great book written by a Wall Street Journal journalist. Can't remember the name of the book, but kind of describes what happened. And these gentlemen got together, all mathematicians, and they created a algorithm. And they only worked on their own money. They were restricted to pretty much $5 billion because it wouldn't work when it got bigger than that. But they were making I think they had a 77% average annual rate of return for a 20-year period, which is just unheard of. They had a money printing machine. And they had a system where, kind of a black box, where it would go out and trade for them based on the algorithms they put in there. And they would trade like mad. I mean, I think they had like a 7-minute average hold time. And so they call that high frequency trading. And then when it would not work, they didn't even know why. They'd have to pull it down, start working on the algorithms again, and test and test and test. And so artificial intelligence will be different than that. But it's still, you have high frequency trading coming in where a computer is making, some form of decision based on an algorithm, a little different than AI, but so I don't know, obviously it's hard to say because it's not really here yet in enough function to really understand what it might do.
There probably is someone trading using AI right now, but
Right.
I don't think there hasn't been any kind of, we'll know about issues when something breaks, essentially.
Yeah,
That's kind
exactly.
of like in 2010, there's that flash crash. It wasn't caused by algorithmic trading, but it was exacerbated by it.
Yeah.
So like any kind of movement was more extreme because of it. And so a lot of those issues were fixed, and we have kind of stop measures in place where we'll lock down the markets if it moves too quickly to one side.
Yeah, that wasn't always there, right? 1987, I was in the business. The market dropped 24% in one day, right?
Yeah.
And that's when they started to put in these restrictions. Now, they've had those restrictions on some of the other more volatile markets, like the futures markets and what have you, where, I think it's, 7%, we have a pause, and 15% it shuts down for the day. We actually hit some of those pauses during the pandemic downturn. It was a 35%. Very quickly. So, yeah, I don't, the things that are usually the biggest problems for the stock market are things that we're really not expecting. That's why I say, like the election itself, everybody's talking about it, everybody's asking about it. Again, I would bet that there isn't going to be a big market reaction no matter what happens, just because it's so well discussed. Versus, hey, there's this virus that we haven't really thought about before that we don't have a natural immunity to, takes down the market 35%. So artificial intelligence, is one of those things that could be a surprise, but it's hard to tell at this point. How much difference is it than the algorithmic trading that's already happening? And there's a lot of that. Matter of fact, there's a good article that was in Bloomberg talking about like the last 10 minutes of the day, right, being some big giant percentage of the trading that happens for the day. That's computer trading, right? So it's not something we do, obviously. The markets are doing really well for a really long period of time. We have lots of bumps and bruises like 2020 and 1987 and 2008 and 2000. But look, we're higher than all of those now. We just keep going. And yeah, you got to go through some of these, 3 to 5 year periods where it can be really rough and not much fun. But overall, the market keeps going. And so there's just the participation, whether it is algorithmic trading or people putting money into 401ks or what have you. That's what makes things kind of grow. And then earnings continue to go. The companies are really good. I mean, the S&P 500 is made up of companies that have demonstrated the ability to produce positive earnings. And the top of that group are companies that just figure it out. I mean, it's amazing how they do. So,
and AI is in its infancy, and so we're kind of seeing people are definitely experimenting and seeing if they can make money. There's been news about AI trading bots that work. So but you never know what time period they worked on. How long they're working on, and so it's essentially if you want to put in the time and effort to figure it out or explore that world, you can do it. But I don't think it's going to affect the day to day right now.
I think the bigger story with AI is what it might do for company profits. Because if we go back, we're aligning this AI move with what happened in the dot-com run up at 95 to 2000, right? And if you look at what has actually come out of that and how much that's increased company profits, it's unbelievable, right? And so that's what makes the stock market go up, is increasing company profits. I mean, for example, just here in our practice, it used to take once a quarter, we would rebalance the portfolios. 2 people doing it manually took 3 weeks full time to do that. Now, got all these online programs, all the assets are linked in from the custodian and what have you. We can rebalance the whole practice in 3 hours, one person, right? That's happened across the board at every company. And so it's one of the things, that I think is, I remember Todd Robinson of LPL Financial giving a speech about the impact of the internet would be really more profits to companies. He was exactly right. And I think that's going to be the bigger impact for artificial intelligence too, will be profits for companies, be able to do things more efficiently.
Yeah, where they're going to save time or manpower.
Yeah. Or even say manpower, or you're able to do more with the same manpower, whatever it is, it's still productivity. Productivity gains are huge. If you want to look at what really drives the stock market, productivity gains. So that's where I'm kind of excited about artificial intelligence and what they're going to be able to do with it. And in 1995, when that first started, we couldn't really see what was going to happen with the dot-coms and the internet. And now we can see it now. I mean, here we are. We're on YouTube on a live stream, right? Yeah. That wouldn't have been available in 1995. And so what is the future going to look like with artificial intelligence? I'm not qualified to answer that question, but I am keeping an open mind to what it might be able to do. I think it could be exciting, and there are people that are in the know that are excited, and there are companies like NVIDIA making a 486% increase in profits in 1 year selling their artificial intelligence chips. So somebody's interested, right? And people with big money, smart people running big companies are interested in this subject. And so we should be also. And I think that they're seeing something, and let's just ride this thing and see how it goes. But it could affect all companies. And again, if you can increase profits, the stock market will grow over a period of time. That's how it works. I mean, there's a very strong correlation there. So anyway, I think there's some other aspects besides what it might be for trading that I think are worth talking about also. All right.
I have a company pension. How much faith should I put into having the pension when I retire?
Okay, so you've worked for a place that has a pension, and the concern would be, what if the pension stops?
Yeah, we're thinking about private pension, not a state or government job pension.
Yeah. So, I mean, I remember a story, United Airline pilots, and United was struggling with their, business as a whole. Yeah. And they ended up having a cut to the pilots, right, to their pension. But if you look at what's happened, that's because those pensions were so large, right? So there is a protection. It's called ERISA. They put together the Pension Benefit Guarantee Corporation. Is that right?
So ERISA Act of 1974. So the Employee Retirement Income Security Act.
Yeah.
basically created the Pension Benefit Guaranty Corporation.
There we go. Pension benefit guarantee. So that's the group, sort of like the FDIC in a way, or what
Yeah.
have you, that we're familiar with, that stands behind the pension up to a certain amount. What are the amounts today for single and joint?
So at 60, your single life is $4,620.17, and joint with 50% survivor is 4158 and 15 cents. And so you can go to their website, look at your age, and they can compare your pension to that. And so essentially, it's kind of like FDIC insurance, where if you have 250,000, the government's going to protect you. If anything above that, you're at risk. And so how big is your pension is kind of that determining factor.
Yeah, but at least some of it's protected. And for most of our clients that have private pension, they don't have pensions bigger than that for the most part.
Yeah, they tend to. Most companies have moved away from pensions, and so their pension systems are kind of what their start of the career, but kind of went defunct.
Yeah, exactly, because that's exactly the scenario that I've seen, where somebody started with a company, they had a pension, and then now it's just sort of sitting there, and it's really been replaced by a 401k with a match. And so that what that means is that they're maybe not getting more than 4,600 at 60 or 4,200 or whatever. So it means that it's all protected. So, but that's to answer that question. That's what you want to do, is you can go look at that, look at your age, see what is protected at your age, and then if you have less pension money than that coming in, it's, again, the government is standing behind that for what that's worth, which so far has been good, right? I mean, the FDIC hasn't failed, or these other issues, these backstops. So I do think that's important. The pension system as a whole, even on the state and federal level, it's a little rickety, because basically people are just living so long. And when you give somebody a guarantee for life or guarantee for joint life, it's a tough road with people living longer and longer. And if they ever actually really solve some of the things that are knocking us off, that'll be even worse for the pension system. So you can get, kind of upside down. I've heard about different, municipalities that are paying out more for people that don't work there than people that do. And so, it'll be interesting to see how that goes. But pensions are slowly but surely starting to, dissipate out of the private sector. That's for sure. So yeah, anyway, that's a good question. Feel good about at least that 46 or 4,200 at 60 in this case, being protected depending on, what your situation is, but that's not bad.
So what are your thoughts on single country ETFs? For example, India and Japan have had some good runs for the last few months.
Yeah. So there's lots of them, right? I mean, Greece and Turkey and, name a country, Mexico, any country. You can buy regions, South America, Asia, Europe, etc. We don't use, at least within our practice, the single country ETFs, only because they have too much volatility. We'll do regions, Asia, Europe, those type of things. We just found that it's very difficult to kind of hang in there on something that has high volatility, mainly because you've got combination of a smaller market, right? I mean, India is not small, but compared to the U.S., they're smaller. And then you've got a currency fluctuation on top of that, right? And so you get these scenarios. I have nothing wrong with them. I have no issues whatsoever. It's just, as a manager of money, I like to kind of hit a lot of singles and a few doubles all the time and try to have some consistency. And then once in a while we'll do something, but it's usually not. If I had a choice of higher standard deviation, I'd be looking at stuff like NVIDIA or, along those lines, more than I would be looking at Japan and whatnot, just from a standpoint of, because the currency can be pretty awkward. I mean, it can really hit you one way. It can be great sometimes too, right? If the dollar falls. So we don't use them a lot here at all, and haven't for a long time. And again, I think personally, just the way that we like to do it is have 3/4 of it and basically just in the market, what we call the core. Try to buy everything and just try to match the market. Take your other quarter and see if you can do something to beat the market by a little bit, and not by a lot. And so I think a lot of times people are trying to hit so many home runs. That's one of my things I've seen. People are trying to hit home runs. They're trying to win the lottery, and then they keep striking out. Home run hitters strike out more on
Yeah.
average. And you can build some really nice wealth just hitting singles and doubles for your whole life. And if you can beat the market by 1% or 2, on average over a long period of time, man, you're really way ahead. The average investor on his own does so horrible. I mean,
Yeah.
Fidelity puts out those studies. Market makes 10%. The average investor makes 2.2. That kind of thing. And
Yeah.
so
A lot of
it's
people jump ship when they shouldn't be jumping.
yeah, well, people buy high and sell low, instead of just kind of hanging in there. Uh, you know, Understand the primary trend at least, like that 10% downturn we had last year, a lot of people get nervous and all these articles coming about a big downturn. Primary trend didn't change, and it turned back around. So you got to hang in there for that part. But anyway, that's just my thought process on money management is a little bit different. It's why we don't do those single country pieces. Again, I don't have any problem with them. You can play those too. It's fine, but not something we do.
So, why are utility stocks surging right now? Utilities kind of been one of the hot sectors the last few weeks. Are we headed for a recession? Usually, when utilities are surging, it's a defensive play.
Yeah, exactly. So you move to utilities because they have a monopoly. People sort of like toilet paper. You need your power,
Yeah.
right? You're going to pay for that power, and so they're a defensive play. They pay a dividend, and so that's another reason why utilities would go up is if the expectation was that interest rates were coming down. So sort of like a bond in a way in that
Hmm.
regards. The value of utilities would go up if interest rates were going down. I wouldn't say that the bet on interest rates going down is better right now either. So it's really probably not that. I
Yeah,
mean,
it's kind of like a
yeah,
mixed bag in a sense. If you think about defensive sectors, utilities is one of the better ones because if you compare to consumer staples or real estate, they haven't done very well in this market, in this high
yeah,
interest market.
yeah.
So they're like,
So it might not be a defensive play then, right? I mean,
yeah,
so you were talking about before the show about kind of a demand surge.
yeah. So with AI, the actual power required for AI data centers is much higher than a regular data center, and so a lot of utilities are getting surge in demand essentially. And so there's been kind of certain companies with nuclear or renewable energy have been seeing more kind of demand from them, and so they've outperformed just the regular utilities.
Yeah, it sort of reminds me of the Bitcoin, the mining aspect of it for it just a surge of need for power and what have you. Uh, yeah, I think that's kind of an interesting story, right? I mean, it's going to, these processes, and usually they make them more efficient over time, but
Yeah.
at the moment they're taking a lot of power to do these massive searches through these big data sets, essentially, right? That's where most of the NVIDIA sales apparently are going to the big seven on the S&P 500, and they are all sitting on big databases, whether it's Tesla or Apple or Microsoft and what have you. And so they're using these AI chips or Meta to get in there and
Yeah.
look at the data and figure out what they can do with it. And obviously, there's a lot of interest. Otherwise, they wouldn't have so much in the way of sales. So
Hmm.
um, anyway, that may be kind of a cause and effect there, where utilities are gathering some more revenues from this piece, which wouldn't be something you would think about off the top of your head, but it's interesting. I think
Yeah,
that's
because data centers use a lot more power than just the average person. And so when you start to have more and more data centers, it can change the utility's whole structure.
and this is what I like about our system. Again, we have say 181 ETFs on our universe list, and utilities are in there. And so we have, basically a competition amongst that list to try to get into our portfolio. And we have a, kind of an algorithm that we've developed to say, okay, these are the ones that are moving the best right now. And we move into those. And then as they fall below a certain cut line, we get out. So if utilities are doing great, we'll be in utilities. We're not at the moment. They haven't moved up enough for enough
So
period of
we
time to
traded
kind of,
into them yesterday.
oh, that's right.
Yeah.
Yeah. Oh, good. So anyway, that's kind of what's happening here too. So good look at that question.
So, what are tax lots, and what do I need to know about them? What's important for the average person to know about them?
So a tax lot. So let's say you have 1,000 shares of Apple and you sell all 1,000 shares. Uh, you might have purchased those at different times.
Hmm.
And so each tax lot is a what you purchased on a certain date at that price. Let's
Yeah.
say on one day you bought Apple 3 times and at 3 different prices. So you have the same date but not the same price. You need both.
Yep.
So in that case, you'd have 3 tax lots. And most times people aren't doing that, but maybe you bought them 100 shares at a time over a number of years.
Yeah.
And every time you bought those 100 shares, that's got a date and a price. So when you go to sell them, those are both important components because the date, if it's less than 1 year, you have to pay short-term capital gains, which is ordinary income. So whatever your normal tax rate is, which is usually higher than capital gains rate, you'd have to pay that. If they've had that for more than a year, that's a long-term capital gain, and that gets you that more better capital gains tax rate. But then every lot has a different gain in total, right?
Yeah.
Whether it's a year or not or longer or whatever, they all have a different total because you have different prices. So I sold all 1,000 at the same price, but I bought, let's say, 10 lots of 100 each over a number of years. They all have different prices, and so I'm going to end up with a different tax on every lot. So every lot is taken separately, all the way across, and then the total taxes owed would be figured out off of that, right?
Yeah. Another common thing is with mutual fund reinvestment of dividends is you build up so many lots because every time a dividend comes in, you get a
Yeah.
new lot, and so over time, and so when you sell, you have the option to kind of control your taxes by picking and choosing lots.
Yes.
If you're really looking to optimize your tax gain, say you're in your 70s and you think you're going to hold one of your stocks for the rest of your life, maybe you sell off a more recent lot that has a lower gain on it and
Yeah.
leave the ones with low cost basis for basically when you pass away to be stepped up.
Yeah, you can pick and choose which lot you sold on that transaction. So if I have a lot that I bought more recently, hopefully it's more than a year ago, so I get the
Yeah.
lower capital gains tax. Maybe I sell that lot because I won't have as much gain if I needed money for something or whatever it might be. So yeah, I think there's some advantages to that. Obviously, if you're a couple or what have you, if one person passes away, there's a step up in cost basis, and essentially the whole lot thing is wiped out.
Mhm.
And there's now considered, so in that case with the 1,000 shares of Apple, I bought 10 different lots over a number of years, and my spouse passes away, or I pass away, whoever it is, my
Yeah.
spouse. The step up for all 1,000 shares is based on the price at the date of death, right?
Mhm.
And you said something interesting about that step up for if it happens on the weekend.
Yeah,
they
if
do.
it happens on the weekend for stocks and ETFs, you'd have to take the prior trading day, you take the high and low, the average of that, and then you average it against the high and low of the next trading day.
Yeah.
And so you kind of have to take those four numbers, add them together, divide by 4, and then you get your new cost basis.
Yeah.
Mutual
interesting.
funds, because mutual funds have only one price per day,
Right.
you just take the average of the prior business day and the next or trading day, and you can average the two, and that's how you get your basis.
Yeah, this is one of like people do this dividend reinvestment program, or this is where it can be really kind of hairy. We had a lot of GE clients coming through at one point in time that GE had a big, what's called the plant now, and we work at GE for 30 years. They bought stock, GE stock, every time their paycheck came out, and then they reinvested the dividends for that 30-year period. And then they didn't have the records. And we had a couple of kind of like forensic situations where we were trying to figure out what the cost basis was on the stock. Because at one point in time, GE was falling like a stone and trying to, people wanted to get out of it. And how do you do that if you don't know what you paid for it? So
Yeah, and if you don't have a cost base,
Yeah.
the government always assumes it's zero.
Yeah,
which is the
exactly.
worst case
So
scenario.
keep track somehow, some way of your cost basis. Now if you have a Schwab account like we have, they track your cost basis for you.
Yeah,
and
the
what
data
have
is
you.
saved essentially.
Yeah, and but these employer purchase programs, which are pretty popular, may not have the same, tracking
Usually
capability.
they go through some sort of custodian, and the custodian will keep that data. It's just when you move it, you want to have some sort of record of prior data.
Yeah, exactly. That's because we've run into that a couple times. That can be kind of a nightmare. All right, what's our next question?
After or during a strong market run, is it okay to take some gains and use it for more luxuries like a good vacation, or to buy like a jet ski or something like that?
Huh. Yeah. I mean, the money is, you can't take it with you. That
Yeah.
thing, it is there to support you. I guess my thought process as a financial planner would just be, you know, okay, yeah, we've had a run up, so we now have more money than maybe we thought because maybe the market even went faster than the average, like it
Hmm.
has been recently. Um, does taking that money off the top, does it affect the basic need of that money, which is to support you
Hmm.
ultimately in your retirement? Whether if you're retired now or you're not retired, right? You've got to have enough money once you get to retirement to supplant your job.
Yeah.
So whether it's pensions and Social Security or rental income, and then your assets and the withdrawal that you can take on those assets, those things have to supplant your job
Yeah.
for the rest of your life. And so can you take it? Well, it kind of depends. I mean, what are you talking about? Is it a $5,000 vacation or a $100,000 vacation? How much money do you have? So the best way to answer that, in my opinion, is in a plan.
Yeah. Some sort of plan.
Yeah, so you'd sit down, we sit down with our clients, and we put the plan is live, the assets are linked in for the most part, and we can go through and say, okay, what if we took a $100,000 vacation for this client? And it works, it doesn't work, okay, maybe 50 works better, whatever it is. The only way to really answer that is not based on this big run up that you had, because that can come and go.
Yeah.
And that run up might just be filling a hole that you already have in your plan. Like if you didn't have enough money to live off in your retirement, just by chance because you weren't able to save up enough when you got to retirement, then having a run up is just filling a hole. It's not actually excess money. So that's what you kind of need to figure out in a planning process, is that excess money. So already had enough to support myself. Now I got this extra. Okay, what if I take a chunk of that extra off and go do something else with it, besides just supporting me for my lifestyle? Now we have clients that travel all the time, and that's part of the budget and such. But we do test that out and make sure that
Yeah.
the budgets can handle it.
And that's why you want to check your plan on a regular basis, because if you have an extra 40,000 you could be taking per year to just increase your retirement, like your happiness in retirement, you should be using that.
Yep.
Because as long as your goals are to use your money for your happiness, and those line up, you should try and use it to the most of your ability.
Yeah, I agree. All right, I think we have time for one more.
What's a good way to estimate retirement expenses while still working? Making a plan, you need that kind of make a guesstimate of your outflows. So how would you build that out?
Yeah, this is a question that comes up all the time when we're trying to do the financial plans, right? Trying to figure out what that outflow is going to be. And, you can get as far down into the weeds as you want to get with this, right? In terms of, they got all these budgeting softwares that are out there that you can start to kind of link up all of your accounts with, and starts to show you, specifically what you're spending month after month. And unfortunately, spending can be a little lumpy. There's certain things that come once every 6 months, property taxes or whatever. There's certain things that come, once a year, that type of stuff. So, however, there are some simple ways too, if you want to go down that path. One thing I always used to do is you can take a look at, how much has your bank balance, the money, that you have at banking, how much has it increased or decreased over the last, say, 12 months? Because if it's increasing, then you have more cash flow, theoretically. If there's nothing unusual about that year, you have more cash flow than you currently are making. And say I'm making 100,000 and I increase my balance by 10. That means, I spent 90.
Yeah.
Right? There it is. Boom, I've spent 90. So that's now part of that 90 might have been some savings in other vehicles besides what you put in the bank. So you should back that out too. Let's say I put, to make it easy, 10,000 into my wife and I's, combined IRAs, And so really I'm spending 80 because I'm not going to probably be putting that money in the IRAs when I'm retired. Does that make sense? So
Yep.
um, another rough rule of thumb, I'm not a big rule of thumb fan, but this one's probably okay. Roughly 80% of current income is quite common. Once we do the calculation, it comes out around there
Yeah, because
fairly frequently.
most people save, and with FICA taxes, it adds up to 20% of their income.
Yeah,
And so that's where you kind of can get a rough estimate. So that's
yeah,
what usually a lot of people do is they take off the FICA tax and then whatever they're contributing to 401ks, and that's a kind of a good baseline.
yeah. You gotta go the other way too, though, for part of that. So 'cause there'll be other savings. You're probably gonna have less maintenance on your car because you're not driving it to work all the time. Assuming you're going to work now, everybody's remote, so who knows? But your maybe your clothes budget might go down, your makeup budget might go down. Those types of things, just because you're not going to work. But your travel budgets or even your healthcare budgets might go up, right? And so that's where it gets to be a little bit tough, but it still seems like 80% comes out quite well. And so, people, I mean, if your health is doing poorly and you're spending more money on that, you might not be spending as much on travel, potentially. So, there's these trade-offs. But I think it's an interesting question. It's actually something we work on all the time. And, sometimes it's just nice to be able to do it simply. But if I'm heading into retirement, I don't want to pull the plug on my retirement without having some really good confidence that this is going to work. So what I want to do is I want to start tracking my expenses. Now that we used to use Mint, and now Mint is gone.
Yeah.
What's the new one now that everybody's talking about that they're using?
I've heard Monarch is
Monarch.
I think Mint converted into Credit Karma. I don't know if it's as good as Mint. Is what I've heard is kind of worse, but I'm not 100% sure. But Monarch was where a lot of people, or I think it was YAMB or something like that, was another budgeting program.
YAB. Yeah, so do some research, find a budgeting program, link up your accounts, your credit cards, your bank accounts, and what have you, and it'll start to tell you very specifically what you're spending. Start to track that, get a really good idea. Try to imagine yourself in retirement and figure out, okay, what would be different here? I'll spend a little bit more here on these things like travel, a little bit less here on maybe gas and clothes or whatever it might be, right? And so you get a good solid number. So, okay, I head into retirement. This is what I'm going to need net, okay? Don't worry about the taxes. Take those out of the calculation. Just focus on the net, because what'll happen is once you get into retirement, you're going to have some more options on where you're getting that money from, potentially. And so, we'll calculate the taxes almost as a separate entity and see how that works. Then you put it all into a financial plan. You run a Monte Carlo simulation. You want to get 850 out of 1,000 successes or better on your plan before you start to pull that plug. So if you have good data inside that plan and you run that plan, it'll tell you whether you should be retiring or not. And there's some other caveats to that. How much of your net worth is revolving around one stock that could go south, or those types of things. So you got to be careful with that. There's some other criteria that you have to look at to make sure. But I think this is really important information, just in the sense that retirement is scary for a lot of people, and this helps to make it less scary.
It's a big change of life.
Yeah, it is, and it's actually great. Most people's number one comment about retirement is, "I wish I would have done it earlier." And they really like it, but there's this uncomfortable nature as you head into it.
Yeah,
kind of
unknown. It's very unknown.
That last 2 years of work or whatever, you're thinking about it, and it kind of gives you butterflies just saying, "Oh, I'm going to cut off this income, and somehow all these other things are going to work out." So get some quality data into a quality plan in front of a good advisor and see how it looks. Would be what I would do. That's for sure. So anyway. That's our show for today. I want to thank everybody so much for coming. Again, send in questions. You can send them in to the Ask Tom at talkmoney.com, and we'll be happy to put those on the next show for next week. You can obviously subscribe to the channel, hit the bell button to get notified. We've got over 1,500 videos on here now, and you can surf through those and see what you find that's interesting. And then lastly, if you want to and want some personalized, customized answers to your questions, you can just meet with Ethan and I. Again, our website link is on this page. You can go to there and hit that button there, and our schedule's live on the
Mhm.
on the internet. So, pick a time that works, and we'll be happy to meet with you. So, look forward to seeing you next Friday. Thank you.